The fatal bug at the core of our existing operating system of ownership and accumulation has just been exposed by the sudden crash in gold and silver prices.
Wait, calling it a fatal bug completely trivializes a massive, tangible loss of wealth. The catastrophic reality unfolding on trading floors right now is not some theoretical flaw.
It is exactly that. It is the death rattle of a failing credit money system frantically pawning its life jackets.
Silver has plummeted by nearly 40% in a matter of days. I mean, gold has crashed aggressively below the $4,500 threshold. People holding these assets are facing real financial catastrophes.
The absolute truth of circular capitalism is that the digital price you're fixating on is a complete illusion. It simply masks the physical reality of resource allocation.
An illusion? This is a violent wave of heavy short selling and sheer market panic. You can't just dismiss the emotional and financial ruin of millions of retail investors as an illusion.
The atomic count of gold and silver on Earth has not fluctuated by a single millimeter during the supposed crash. The physical reality remains completely unchanged, regardless of what the digital indicators say. This drop is purely information noise.
The mechanics of the market completely overwrite this information noise theory. We are witnessing a massive wave of short selling. It's a clear, legal market mechanism where participants are actively betting against the asset.
Betting on shorts in this environment is the equivalent of spectators at a fire betting on which pillar of the burning building breaks next.
But short sellers are driving true price discovery. They are causing a legitimate market correction after months of overheating. They provide crucial liquidity.
They are not trading physical gold. They are trading electronic data named gold.
The order book dictates the reality of global commodities trading. When institutional players dump paper contracts, it forces the market to find the actual clearing price.
Rejoicing over cheaper gold prices because of paper derivative dumps is the logic of a child who rejoices that a luxury restaurant changed the prices on the menu, mistakenly believing the food itself has lost its value.
The menu dictates what people can actually afford to eat.
The menu is not the meal. Believing that these manipulated paper shorts dictate the physical distribution of elemental resources is like believing a magician's trick is a miracle.
Look, the screen flashing red triggers automated stop losses. It breaks maintenance margins. Investors are facing brutal margin calls, frantically gathering cash just to survive until tomorrow.
Do not dress up a digital guillotine as a standard market dynamic. It is a system specification.
Stop losses are legally binding contractual obligations. When a trader's equity drops below that mathematical threshold, the algorithm automatically liquidates the position to protect the broader financial system.
The system is actively driving investor sheep to the cliff, sharing their wool in absolute terror through forced liquidation, and then buying that exact same wool back cheap.
If brokers didn't forcefully liquidate underfunded accounts, the clearinghouses would go bankrupt. That is a tragic but standard market rule designed to stop infinite contagion.
It is an organized theft ring, operating in plain sight, not a barber shop. A legitimate market function would not resemble a barber taking the scalp, not just the hair.
The investors voluntarily chose to take on leverage. They signed the margin agreements, fully understanding the risks.
The system intentionally induces the panic to break their borrowed wings of leverage. It triggers the margin calls specifically for the purpose of plucking feathers from the crashed corpses.
Well, what about the people who avoided leverage entirely? The retail investors who listened to the advice to buy physical assets months ago are now bleeding from massive unrealized losses.
Focusing on fiat valuation introduces a fundamental number bug into the analysis. You are measuring survival assets using a dying currency. It does not lose a single millimeter of its physical fire extinguishing ability.
You can't put out a margin call with a physical fire extinguisher. If an investor needs to liquidate that physical gold today to cover real-world expenses, they are taking a massive haircut.
Holding physical gold right now is exactly like holding a brick in a burning house.
A brick that is rapidly losing its ability to buy food, shelter, or security. The bank requires fiat for a mortgage payment, not a silver ingot.
Because their hand feels hot from the perceived unrealized loss, they scream and want to throw away the brick away. But if you throw away the physical asset and step outside the burning house, you are left with nothing but ashes.
The moment they interact with the broader economy, the unrealized loss becomes a realized catastrophe.
Paper fiat is ashes. The entire psychological operation of this price crash is designed to make you throw away the physical and return to the leveraged casino.
The institutional algorithms are reacting to macroeconomic shifts, not running a psychological operation. We are seeing rising bond yield and a strengthening dollar.
Meanwhile, the casino owner touts that ships are best. They publicly praise fiat while quietly counting real gold ingots in the back room.
Capital is rotating into yielding assets. That is just standard portfolio management.
They are actively exploiting this conceptual gap to execute a massive wealth transfer, hoarding the exact physical assets they convince the retail market to discard.
Historical pricing data completely contradicts this narrative of an organized wealth transfer. Look at the long-term charts. Even after the severe 40% crash, gold is still higher today than it was 4 years ago in 2022.
Equating this engineered collapse to standard trading ignores the structural reality of the exchange.
Standard investment theory dictates buying when an asset is cheap relative to its recent highs. The macroeconomic factors established a higher baseline floor.
What you call standard trading is nothing more than the martial art of how to cash out chips without getting punched by the dealer in a rigged casino.
It is a painful cycle, yes, but it is a normal market cycle. Navigating this volatility is simply the struggle of trading.
Mocks the idea of it being cheap by comparing it to a 100-kilogram weight gainer who loses 10 kilograms and confidently calls themselves a successful slim dieter. The baseline was manipulated from the start.
The baseline moved because global liquidity metrics expanded. Retail investors can and will recover their value once this panic subsides and the algorithms rebalance.
The high prices were a trap. They were a mountain of corpses built by orchestrators who waited patiently for the locusts to swarm.
The charts and macroeconomic triggers show a market doing what a market does, finding a clearing price. We have to trust the mechanics of supply and demand to stabilize the system.
They waited for the liquidity and then initiated the perfect Niagara drop. The existing system is a rigged game of information asymmetry, where the massive survival energy becomes electronic seafoam. The current financial operating system is irreversibly collapsing into an organized resource grab by the elites. Abandoning digital illusions and transitioning to circular capitalism based on physical resource reality is the only rational investment for survival.